Hello everyone, thanks for checking out my video. All three US major indexes capped off a winning week as the market rallied on a big interest rate cut by the Federal Reserve. Both S&P 500 and Dow Jones surged to a record high, with investors anticipating a soft landing for the US economy. Meanwhile, 3 weeks of September has passed. The US stock market sold off hard on the first week and rallied even harder on the second and third week of September. As we approach the end of the month, is it time to say goodbye to the bears? Let's cover what's driving the current rally and how should we position ourselves as we close out the final week of September. As usual, do watch throughout the video to find out more. Okay, the highlight of last week was the Federal Reserve's decision to slash interest rates by half a percentage point. This is actually quite an aggressive start to its first easing campaign since the early days of the COVID pandemic, which was about 4 years ago in 2020. In addition to the rate cut decision, the Fed indicated through its dot plot plans that there is likely another 50 basis points of cuts by the end of the year. During the press conference, Jerome Powell shared that they have achieved a situation where they can restore price stability and reduce inflation without the surge in unemployment rate. Basically, the Fed is confident that inflation is moving sustainably towards their 2% target without hurting the labor market by too much. In short, the path towards achieving a balance between their employment and inflation goals is intact. Okay, in case you don't know what does the rate cut mean, well, to put things in very simple terms, lower interest rates are generally considered positive for companies and their stocks, especially for high growth industries such as the technology sector. Reason is because lower interest rate means lower borrowing costs, which can reduce the company's debt and perhaps even encourage them to take on riskier investments, assets, and innovations. Well, right after the announcement by the Fed and during Jerome Powell's press conference, the market movement was really volatile with lots of whipsaw movements. Then, on the very next day, we saw a delayed reaction by the market as investors digested the news and Powell's words. They basically kind of concluded that the rate cut decision somewhat suggests a possible soft landing for the US economy. As a result, the market rallied really hard on that day. For this week, on Monday, PMI data for the major developed economies will be in focus for investors and central banks around the world. This data will provide a snapshot of the manufacturing and service sector activities, giving insights into the performance of the world's major economies in September. Signs of further economic weakness in the PMIs will translate into greater chances of more aggressive rate cuts by the end of the year. While on the other hand, signs of resilience will add on to a more cautious approach by the various central banks. Okay, but perhaps the most important official economic data of the week will be the core PCE inflation reading, which is a preferred measure of inflation by the Federal Reserve. A lower core inflation rates will definitely be welcomed by the market, as that will mean that inflation is indeed falling sustainably towards the Fed's 2% target. This will further support more rate cuts before 2024 ends. On a side note, Meta will be holding its Meta Connect Developer Conference on 25th September Wednesday, where they will talk about all things AR and VR, chatbots, headsets, smart glasses, and generative AI. Let's see if the products can further push Meta stock price to another record high. Finally, just so you know, lots of Fed officials will be speaking this week. But since most Fed officials had supported that 50 basis points rate cut, I suppose most of them will not spring any hawkish or negative surprise for the market this week. Let's now check out the various charts, starting things off with SPY again. Okay, things are looking interesting on the charts because a few of them are showing bearish and bullish patterns, and it can be confusing for some people, so let's break them down. First of all, for SPY, there was a potential bearish double top pattern, which then became a potential bearish triple top pattern. So that's bearish, right? But then there is also a potential bullish inverse head and shoulder pattern formed on the same chart, which is bullish. This is the reason why I always paint both the bullish and bearish scenarios for viewers. It's not so much of trying to have a capture or scenario whereby no matter the market goes up or down, I can say that my analysis is accurate. That's not my intention. My intention is to highlight the key resistance and support levels, and when they are breached, then the respective bullish or bearish thesis will play out, and that's when we can ride along the trend. Anyway, it appears that the bullish pattern has played out for SPY, as SPY broke above the neckline marked by that blue line. So what's next? Okay, for the bullish momentum to continue, obviously it needs to take out the recent record high of 571. Above it, I would call it an uncharted territory, and it may go towards 580 before a meaningful resistance comes in. But take this 580 level with a spoon of salt, because honestly at all-time high, nobody can predict when market makers will start taking profits by selling off. Therefore, at all-time high, I will adopt the wait and observe approach. Another possible bullish scenario would be SPY has a retracement back to the neckline, which is at around 563 or 564, and then bounces off it. Remember, what does this movement call? It's the classic retrace, retest and rebound. If this happens, again, SPY could enter the uncharted territory, which is above 571. Okay, in terms of the bearish thesis, watch for two levels. First, it's the recent all-time high at 571, which is where the 61.8 Fibonacci extension level is. Second, watch that neckline at around 563-564 level. If we get rejected at 571 and then fall below the neckline, then obviously the market is pulling back. When this happens, I will avoid opening a long or bullish position, but at the same time it will not excite me yet. Because to me this is just a normal retracement. I will only be excited if SPY continues to decline towards the 50 moving average at around 547. That will be a 3.7% pullback from the current price. Not too bad to dip my toes in. Below this level of 547, watch for 536 to 539. That's where the shoulder levels are. If this area breaks, then the bullish inverse head and shoulder pattern can be said to be invalidated. Moving over to Apple, can you see the similarity between this chart and SPY's chart? Basically, there is also both the bearish triple top pattern and bullish inverse head and shoulder pattern forming on Apple's chart. Okay, but I must say that the inverse head and shoulder pattern is not the most classic or textbook version. I mean, market makers will not paint the chart so nicely for you. Textbook is textbook after all. We have to be flexible with chart reading in real life. Anyway, the difference between Apple's and SPY's chart is that Apple's bullish pattern is not playing out, at least for now. In fact, it isn't giving any clear indication. So how do we look for indication or confirmation? For the bullish thesis, watch how Apple reacts to 233 if it tests this level again. It needs to break above this level to invalidate the bearish triple top pattern. For confirmation, it actually has to test or even break the all-time high level of 237. When that happens, just like SPY, we are looking at uncharted territory, and Apple can run as long as the market makers want before they take profits. One potential good news for the bulls is that the MACD just had a bullish cross. Another green day could potentially see Apple breaking above the triple top pattern. On the other hand, if we see a rejection at 233 this week, or if Apple continues to fall from the current price of 228, I think there is a high probability that Apple will head towards the gap between 222 to 224. This is also where the 50 moving average is. If Apple bounces from here, then the bullish momentum is still intact. But if it doesn't, I think we can expect Apple to fall towards 218 level. But at the end of the day, as long as Apple doesn't break that 61.8 Fibonacci level at 210, we are good. However, if it breaks, then the bearish triple top pattern is playing out, and that's when I do think we could hit towards 200 level. Let's now move over to Tesla. Tesla is looking good in the short term as it has been creating higher lows as shown by the purple line since the global sell-off on 5th August. Not only that, it almost filled that big gap between 235 to 245, so that's bullish. And if you wish to ride this bullish momentum, here's what to watch out. First of all, Tesla needs to fill the remaining gap, which is around 244 to 245. And more importantly, don't get rejected. If we stay above this 240s range, then I think we could ride the wave up towards 250's range. That's a good 10-point jump. Okay, even if we get a bit of retracement this week, that's fine, but watch that 61.8 Fibonacci support level. As long as we stay above it, Tesla's bullish momentum is still intact. But since Tesla is so volatile, you might want to give yourself a bit more buffer, and that is the purple line. Tesla needs to stay above this line to push higher. On the other hand, if this purple line gets breached, pay a bit more attention, okay? It means Tesla's price movement of higher lows could be coming to an end. That's when I won't open a bullish or long position. Below this purple line, there is a dynamic support level, which is the 50 moving average at around 223. If this breaks, then Tesla is bearish. The last line of defense lies at the 200 moving average, which currently sits at around 202. This level roughly coincides with the 23.6 Fibonacci level. Okay, overall I would say Tesla is bullish until the purple trend line and the 50 moving average got breached. Meanwhile, something interesting to share, a potentially good news for the bulls. The MACD on the monthly chart just had a bullish cross. The last two occasions when we had a bullish monthly MACD cross were in 2019 and 2017. In 2019, after the bullish cross, Tesla rallied 1500% before the MACD had a bearish cross. Okay, don't get too excited because this is clearly an outlier. But for 2017, Tesla rallied 20% before MACD had a bearish cross. Anyway, not saying this will happen, just saying this is a potential good news for the bulls. I'm just reading off the chart. There are also two caveats to this. First of all, September has not ended. Secondly, we have a huge event coming up on 10 October where Tesla will unveil their robo-taxi plan. Let's see if that event can excite investors and to confirm the monthly MACD cross. If it can, wow, the upside could be very massive and huge. But of course, if investors don't like the event, I don't think I need to warn you that the waterfall towards the downside could be massive as well. Let's now check out Google's chart, which looks the most fascinating to me. Not sure if you can see on the screen, there are 4 gap ups in 7 trading days. That's very amazing. I know gaps usually get filled about 80 to 90% of the time, but when you have this series of gap ups, it simply means bullish as buyers are rushing in. So will the bullish momentum continue this week? Watch out for that 164 or 165 level. This is a double resistance level formed by the 50 moving average and the 38.2 Fibonacci level. If Google can get above this, honestly, my view is there is a high probability for us to see 170 again. At 170, just be a little bit more careful because if we continue to search from here towards 170 without a break, then the RSI could hit overbought level. And also at 50% Fibonacci level, investors tend to take profits. Which means we could see some form of resistance here. But that being said, it also means if Google doesn't get rejected here, can you see the big gap between 176 to 181? That will be the next target. In terms of the downside, I have shared in many of my recent videos that the 200 moving average for Google has proven to be a very strong support. So once again, watch this level closely. It's currently sitting at 158. Just like the last time round, if Google falls below this moving average again, I may consider selling another put option, which is a bullish move. Anyway, just some words of caution. If Google falls below the 200 moving average, then I think we could continue heading towards the gap between 151 to 152. From here, the bulls wouldn't want to see Google to go and retest that recent low of 147, otherwise that will be quite bearish. When that happens, there is then a high chance for Google to continue its decline towards the huge gap between 142 to 145. I will most likely be a buyer of Google shares at this area. Let's now check out Meta's chart. Similar to SPY and Apple, we had a bearish triple top pattern and a bullish inverse head and shoulder pattern forming on the chart. Okay, got to be really honest with you, I thought the odds of the bearish double or triple top pattern playing out is higher than the bullish pattern, but I was wrong. The moment Meta had a bullish cross on the MACD and then broke above the neckline and triple top resistance, I knew I was wrong. Again, like I always say, this is the reason why I always look at things from both bullish and bearish perspectives and be ready to change my position when the trend changes. Anyway, for this week, since Meta has entered an uncharted territory, it's again anyone's guess when will the market makers start taking profits. And if you must know, the next resistance level is around 575. By the way, with the breakout from the neckline, it means that the inverse head and shoulder pattern is playing out. Remember, I mentioned in a few videos, if this pattern really plays out, we could see 600 by the end of the year. At one point, Meta was trading at low 500s and 600 seemed so far away, but right now it's only about 7% away. Okay, this bullish inverse head and shoulder pattern could be invalidated if Meta falls below 544 again. But for me to call Meta bearish, it needs to go below 505, which is a double support level formed by the 38.2 Fibonacci level and the 50 moving average. Moving over to Microsoft's chart, Microsoft is the opposite of SPY, Apple and Meta. Instead of a bullish inverse head and shoulder, it has a bearish head and shoulder pattern. And instead of a bearish double or triple top pattern, it has a bullish double bottom pattern. Okay, I hope it's not too confusing for you. Anyway, just when I thought Microsoft bearish head and shoulder pattern is going to play out, and with the 200 moving average briefly breached, Microsoft found a strong support at this 395 to 400 zone. It basically bounced off this area, reclaimed 200 moving average and went back up. Since it has gone above the shoulder level, this means that the bearish head and shoulder pattern is kind of invalidated per se. Okay, from here, if the bullish double bottom plays out, we could see Microsoft grinding towards the all-time high of 467 by the year end. But before that, it needs to show some indication, and that is to hold above 436, where the 61.8 Fibonacci level sits. As Microsoft falls below this level last Friday, so you might want to watch this level closely again this week. Let's see if Microsoft can reclaim this level. If it can, then it's bullish. Otherwise, I think we can expect Microsoft to retest the support level of 426 as well as the 50 moving average of 421. The ultimate support level lies at the 200 moving average, which now sits at 413. This was an area where I wanted to sell some put options 2 weeks ago, but before I knew it, Microsoft reclaimed this moving average and went back up. Okay, let's now check out the AI favorite, Nvidia. Nvidia's chart actually looks quite straightforward to me. It did have a little bounce off the 102 support level, but it is not out of the woods yet. As you can see, I have this blue downtrend line on the chart, so for Nvidia to regain its bullish momentum, it needs to push above the trend line decisively. Ideally, we would want to see it going above August high of 131. When this happens, then yes, we can say Nvidia is bullish again. Otherwise, at this moment, I wouldn't say Nvidia is bullish. In fact, it's struggling at the 50 moving average level, which is around 116, and couldn't find a clear direction last week. Therefore, come this week, let's see if we can get a clearer indication or direction from Nvidia, which means the stock has to break free from the 50 moving average. If it breaks below it, there is only one important support zone that I am looking at, which is around 100 to 102. Because when this area breaks, just like the previous round, we could expect to see low 90s again. That will get me excited as I might step in to sell a put option. So on the other hand, if Nvidia breaks above the 50 moving average, then just like what I mentioned earlier, watch if there is a rejection at the blue downtrend line. A solid surge above the trend line could really open a lot more upside for Nvidia. Okay, moving over to the options trading segment. I have 3 trades to update in this video. The first one is this cash secure put on Tesla that expired on 13 September when I was away. The contract was sold on 6 August with a strike price of 160. The reason for making this trade back then was quite straightforward. On 5th August, there was this global sell-off which I believe you are aware of. At that point, I was of the view that the massive sell-off was a bit of an overreaction. And usually after an overreaction, there will be a bit of stabilization, which means we could see a possible sideways movement or a small bounce. Specifically for Tesla, the candlestick went out of the Bollinger Band, which gave it a decent chance of a sideways movement or a small bounce. Therefore, I stepped in to sell a put contract the very next day on the 6th of August. Since then, Tesla has been on this decent uptrend, and my 160 strike price was not close to getting breached at all. As a result, the contract expired worthless on 13th September, and I kept the full premium of $320 without having to close the position. For more information about this trade, you can also check out the video linked at the top. Alright, the second trade to update is another cash secure put on Tesla that expired, but this contract only expired last Friday 20th September. The option was sold on 14th August with a strike price of 170. There were a few reasons for making this trade, which I covered the thought process in my previous video. Again, I have linked it at the top, do check it out. Anyway, to summarize, there were a few positive catalysts in the macro environment, and Tesla's chart was also showing some positive signs such as a series of higher lows. Guess what, maybe I was lucky. Tesla popped more than 6% the very next day. It then went on this nice uptrend and had not closed below $200 since the day I sold that put contract. Which means my 170 strike price was nowhere near getting breached. And just like the previous contract, I got to keep the full premium of about $250 without having to close the position. Okay, the third trade, a new trade. It's yet another cash secure put on Tesla. Well, by now you should know how much I love to trade Tesla, mainly because of its volatility. Anyway, this put contract was sold on 12th September when I was away, with a strike price of 190 expiring on 25th October. The thought process behind this trade is again quite straightforward. Tesla broke out of the blue downtrend line that's bullish. It did a little retracement to try to retest that trend line and rebounded off it. That's even more bullish. To add on, it has been creating higher lows since the 5th August sell-off. With this series of bullish signals, I stepped in to sell the put contract, which is a slightly bullish move. Anyway, I would like to bring your attention to this other trade. In fact, I want to do a comparison between two trades. So, the one that I have just mentioned was a Tesla cash secure put sold on 12th September when Tesla was trading at around 229. The days to expiration is 43, IV is about 68%, and I receive a premium of $580. The other cash secure put on Tesla, which I had covered in one of my previous videos, was sold on 21st August when Tesla was trading at around 221. The days to expiration is 37, IV is about 50%, and I receive a premium of $283. If you were to compare them closely, you will realize that my recent trade gives me a much better risk to reward ratio. As you can see, the earlier trade gave me $283 premium, while the latest trade gave me more than double the premium at $580. For the earlier trade, Tesla was trading at 221, which is closer to the 190 strike price as compared to the more recent trade when Tesla was trading at around 229. This means the first trade has a higher risk of having the strike price breach. I'm not sure if you get what I am trying to say here. Okay, basically earlier on, if Tesla was trading at 221 and with only a premium of $283, I was already willing to enter the trade. So, when Tesla was at 229 recently with a juicier premium of $580, how could I resist not entering the trade, right? The risk-reward ratio is better for the recent trade, isn't it? Okay, but if you are sharp enough, you may have realized that the second trade has a longer days to expiration, which contributes to the higher premium amount. That's true, but look at the IV as well, which is the implied volatility. The second trade's IV is at 68%, much higher than the first trade of 50%. In case you're not aware, the higher the IV, the more expensive the premium is, which is good for option sellers like me. So yep, that's one of the main reasons why I stepped in for the recent cash secured put on Tesla. The risk-reward ratio is just too appealing and attractive. And right now, this latest trade is sitting on a nice paper profit that is higher than the full premium of the previous trade. And I can choose to lock in this profit anytime by closing the position. Alright, I hope you learned something today. If so, do help give this video a thumbs up. Thank you. Alright, last week was an interesting week, mainly because of the surprise 50 basis points interest rate cut by the Federal Reserve. In case you don't know, history is not on our side for this size of rate cut. So, apart from the emergency 0.5% cut during COVID, the last time the FOMC cut by 0.5 point was in 2008 during the global financial crisis. During those two occasions, on average, the S&P 500 lost about 15% in 12 months after the first cut. But yes, there is a but. Both of these periods saw a recession, which is something that Jerome Powell and his team claim that they can avoid this time. More but and more caveat, we only had two occasions to draw reference from. Therefore, some may argue that this year is different. Well, indeed, this year is definitely different. I mean, whether US economy will go into recession in the next 6 to 12 months, we really wouldn't know. But what makes this year different from the other two occasions is that we are currently not in a major crisis. Okay, sharing some of my views and thoughts. First of all, I am wondering if the Fed had only started with a super-sized 50 basis point rate cuts during a crisis, why are they starting with a 50 basis point cut this time when we are not in any sort of major crisis? If Jerome Powell views that the US economy remains strong, unemployment rate remains under control and that they are not behind the policy, why didn't they go with a 25 basis point cut? And don't forget, Powell is the same person who previously said that inflation was transitory, but then inflation skyrocketed. Okay, in case you mistook me as being bearish, don't get me wrong, I am merely playing the devil's advocate here and be a little skeptical. I mean, it's always good to be a bit more cautious, isn't it? At the end of the day, Jerome Powell could have learned from the previous inflation lesson and decided to move a step faster to bring the rates down before something in the economy cracks. And the good thing is that so far, at least for the past few months, various economic and job data do support his view of a possible soft landing. Anyway, whether there are risks below the surface that we do not know, only time will tell. We will only know if this time is truly different from the previous two occasions months down the road. And if indeed the Fed is able to avoid a recession, this year will go down into the record book as the first time in history where rate cuts begin with the 50 basis point cut, and yet the US economy did not enter a recession. That's a big if. Meanwhile, the market rally over the last 2 weeks proved that one should never be too fixated on a particular outcome. Remember, I presented the bearish statistics of a typical September? The recent rally simply shows that history may not be on our side, but sometimes this year or this time could be different. It could be the outlier. That was the reason why I stepped in for Google 2 weeks ago, which I shared in my video. I also mentioned that I made that move just in case there is a rally despite a potential bearish September. And well, the market ended up rallying to all-time high, though I was expecting a deeper pullback. Nevertheless, I am glad that I managed to snap up some shares and sold some put options, which is a bullish move. Okay, all in all, don't spend too much time predicting the market direction for next week, next month or next year. If you are a long-term investor, be a patient buyer. A market pullback will always come, though it may not be as big as one would anticipate. It is still opportunity to pick up shares of good companies. Alright, that's about it for this video. Thanks for tuning in again, and please help to tap the like button if you haven't. Thank you very much.